Hi and Assalamualaikum. My name is Muhammad Nurafiki bin Muhyiddin and I will present about capital structure. First is what is capital structure? Capital structure is the specific mix of debt and equity it employs to fund its overall operation and growth. Equity capital is derived from a company's ownership shares and claims on future cash flows and earnings. Bonds and loans are examples of debt, while ordinary stock, preferred stock, and retained earnings are examples of equity. The balance sheet includes both debt and equity. Assets both with finance or equity are also reflected on the balance sheet. Long-term debt, short-term debt, common stock, and preferred share can all be part of a company's capital structure. When examining a company's capital structure, the percentage of short-term debt versus long-term debt is taken into account. When analysts talk about the capital structure, they are usually talking about a company's debt to equity, which shows how dangerous its borrowing practices are. A corporation that is extensively financed by debt often has a more aggressive capital structure, with posing a bigger risk to investors. However, this danger might be the company's major source of growth. Second is determining optimal capital structure. Optimal capital structure is to maximize the firm's intrinsic value. The cost of capital structure must be reduced to the lowest level. When you get to this stage, you found the best capital structure. Optimum capital structure may be defined as the capital structure or mix of debt and equity that leads to the firm's highest value is known as the optimal capital structure. The optimal capital structure is one in which the weighted average cost of capital is the lowest and the firm value is the highest. The appropriate capital structure is an important choice for financial management since it is linked to the firm worth. The capital structure of a corporation refers to the company long-term debt and equity funding. Having the correct balance of debt and equity financing in the firm is what optimal capital structure entails. Most of companies must weigh a number of trade-offs when deciding on debt financing, including cost, liquidity, maturity, and the basis and frequency of interest rate receipt. Because the present value of firm future cash flows equal the present value of its future cash flow in equation. The firm worth is maximized when the cost of capital is lowest. In other words, when the discount rate is lowest, the present value of future cash flow is largest. Next is factor effect capital structure and capital structure decision. An optimal and ideal capital structure is a mix of debt and equity that reduce the firm-weighted average cost of capital, or as we call it, the cost of capital. As a result, a company capital structure is determined by its profitability as well as its financial risk. A corporation with a solid capital structure is one that optimizes and maximizes the value of equity owners, which would otherwise allow the price of stock to rise. As a result, a number of factors affect capital structure and capital structure decision. The cost of capital is one aspect that might influence capital structure decision. The costs and expenses associated with various capital components will definitely affect capital structure decision. In the world of finance and business, risk is one of the most essential factors that investors should consider when deciding on their capital structure. Flexibility is another factor that affects capital structure and capital structure decision. Next is financial distress. Financial distress is a term which is widely used in the world of corporate finance. Thus, financial distress occurs when a business or individual is unable to generate adequate revenue or income to satisfy or pay its financial commitments. This is usually owing to high fixed expenses, a high percentage of illiquid assets, or revenue that is affected by economic downturn. Individual may experience financial distress as a result of bad budgeting, overspending, having too much debt, being sued, or losing their job. Next is the integration of tax effects and financial cost distress. The cost of financial distress situation in which a corporation is unable to repay its debts and liabilities. Indirect expenses, conflicts of interest, bankruptcy costs, and greater capital expenditure are all significant costs linked with financial difficulties. Debt finance is fairly frequent in today's organization framework. To finance their activities, businesses take on debt with a short-term or long-term return. According to Modigliani and Miller, in the presence of corporation tax, debt leads a firm value to rise. On the other hand, financial analysts and specialists frequently believe that the expenses or bankruptcy will reduce the firm's total worth. Next is agency cost of equity. The agency cost of equity is the conflict of interest that exists between shareholder and debt holder or creditor of a company as a result of management choice. The agency cost of equity are measures taken by debt holder and to limit what management can do with their capital if they perceive management priorities activity that benefits shareholder rather than debt holder. The agency cost of equity is frequently combined with the agency cost of equity, which represent a conflict of interest between management and shareholder. Appropriate budget planning, adherence to accounting rules, restriction on corporate spending, and the adoption of personal initiative are all examples of strategy to lower both equity and debt agency costs. Next is pecking order theory. According to the pecking order theory, corporations prioritize their financing sources and reserve equity financing as a last option. Internal funds are used initially, then debt is issued if they are gone. When issuing further debt is not sensible, equity is issued. According to this theory, firms follow a hierarchy of funding sources, preferring internal financing when it is available and debt over equity when external financing is necessary. According to Berger and Udall, the hierarchy is dependent on the firm's size and stage of development since each stage of growth has a different amount of information, asymmetry, and financial requirement. The pecking order theory describes the function of private equity and more importantly is the reason for its existence regardless of a company's stage of a growth or size. Unlike traditional bankers who normally just provide financial support to businesses, the private equity industry provides managerial capability to businesses as well as information to the whole financial system. This characteristic distinguishes this business from credit or banking organization. Last is signaling hypothesis. The act of using insider knowledge to establish a trading position is known as signaling. When an insider exposes critical information about a firm, it causes people who do not normally have insider information to purchase or sell the company share. Outsiders regard the insider activity to be a market signal. Tracking the shareholder and trading position of a company insider can provide a market signal. Insiders are generally the company's top executive or other major stockholder. They may have a decision-making authority and access to confidential corporate information.